Core inflation came out today. And as you can see from this chart, it's a little bit hotter than expectations. Adam, what are your thoughts on the implications for this for portfolio construction?
Yeah, I don't think that today's reading sort of changes anything. I think we're on a glide path towards a base case of a 25 basis point Fed cut in September, and something would have to happen extreme in either direction, I think, for that to change. I think that's fairly baked in. So look, I don't think this is cause for any portfolio changes. It's just another data point that speaks to where I think the base case of where the market thinks we're at, which is a 25 basis point cut, and an economy that's doing okay, but clearly slowing down and starting to show a few cracks on the edges, which is I wouldn't say cause for concern, but cause to pay particular attention to each incremental data point.
Austin, what are your thoughts?
I think it's interesting because the fixed income market did appear to get a little ahead of itself on the interest rate cuts. It's also quite fascinating to watch the talking heads talk about how the Fed's behind the curve and they should be doing 50 basis points or more. And then you have other talking heads saying that, maybe they'll do 25 basis points. It sure does seem like 50 basis points would be overdoing it given the CPI print today. And the market seems to be adjusting to that a little bit. And it'll be interesting to see how this goes. As we've kind of said over the last few months, instead of focusing on one data point, let's try to focus on the data in general, because data points tend to get revised over time. And so focusing on one point may lead you astray when it comes to making investment decisions.
Austin, how much weight do you put on core CPI versus the big CPI print?
I mean, I think another question might be how much weight do we put on CPI, and it's actually very little. It's good to understand how the market's reacting to some of the data and data points that come out, but in reality, this is all backwards-looking data, right? And so we're trying to invest on a forward-looking basis. So we'd like to understand where the economy is. In reality, the revisions are going to have a greater impact than any data point that's coming out, and we try to keep that in mind as we look forward for what we think are the likely outcomes in the future.
And I think that goes for every key data point that people are focused on right now, right? Whether it be CPI or PPI or the unemployment rate or the monthly jobs number or the weekly jobless claims. Any huge market reaction to one of those single data points suggests that the market is trying to figure out what's going on, doesn't know. Their volatility is up, and we're at some sort of kind of inflection or potential turning point. But each individual data point taken on its own, you can't put too much emphasis on.
Yeah, going forward, I think just think more about the fact that we're changing regimes from a Fed tightening cycle to a Fed easing cycle, which also is changing regimes from a rapidly growing economy to probably a less rapidly growing economy. So that's going to create some volatility as the market digests all this data that comes out. We don't want to overreact to short-term data points. We want to think kind of where things are going from a broader economic cycle perspective, which I guess these data points give us an idea of where we are. But in reality, we'd like to zoom out and see, where we are relative to last year, last 3 years, last 5 years, last 10 years to get a better idea of where we might be in the cycle. And that allows us to allocate capital more effectively for the point in time.
Yeah. And there's another regime change I think we're going through, which is going from a market where all that mattered were 7 companies and AI to a market where they actually realize that there is another 490, 3 companies in the S&P 500 that are also relevant.